The Quantum Group USA, LLC in California, DBA Quantum Distribution and Insurance Services. Advisors are responsible for following all insurance, DOL, FINRA, SEC, broker-dealer, and compliance officer approval requirements prior to distributing this information to clients. Welcome back to more Market Insights, and today we're looking at where the markets stand after a surprisingly strong late summer and fall rally, how earnings and valuations are shaping investor sentiment, and what could influence the path into year-end in 2026. We're going to touch on the role of AI and concentrate on mega cap names and the uncertainty surrounding future Fed decisions. And what's been going on is we've got, let's see, the NASDAQ is up, S&P. I mean, everything is like 6 months of just steady gains, yet it doesn't feel right. Why is this the hated bull market we always talk about?
Well, I think I got to go back to June maybe, right? Mm-hmm. We call this the most hated V-shaped recovery bull market that I probably have ever seen. And you just touched on it. We just went through, which is typically the worst 3-4 months of the market every year. August, usually market peak. September is typically the worst month. Then you have October, the 87 crash. So a lot of people think that October is typically the worst month for markets. It's really September. And we just went through 3 straight up months. October finished up about 2% on the S&P. 6 straight months of gains for the S&P and the Dow. 7 straight months of gains for the NASDAQ. So it's still the most hated rally, in my opinion. When you look under the hood, and we've been talking about this, there are some warning signs. I just saw a stat, the Russell 3000. So let's look at the larger picture. About 6% of the stocks inside the Russell are at the highest mark going back to April, which was Liberation Day, right? Mm-hmm. Liberation Day was the end of the world. Tariffs are going up. Inflation is going to go through the roof. Inflation's actually in check. A couple things when I look back to some of the other podcasts that we've done over the last 6 months, looking at this bull run up to 6,900, almost 7,000. When we look back in, I believe it was June, May or June, we'll call it, there were some signs that I alluded to, which are probably bullish for the market. And that was low margin debt. Consumer confidence was at all-time lows that were coming out. The bull-bear read-ins, really bearish at the time. A ton of cash on the sidelines. And then the hedge funds were ultimately one of their biggest shorts in a long time. So you have all that catalyst of if there was a little bit of momentum to the positive side of the market, you had the short coverings. You had cash coming in on the sidelines. You had the Fed that was potentially going to lower rates, which affects money market returns. So we had this catalyst that we talked about for the potential for a face-ripping rally, which is what we got. When you look today, margin debt is the highest it's been, over $1 trillion now. So leverages come in. Hedge funds have become more net neutral on their long short. So when you just look at the market as a whole, again, we always talk about price dictates everything, right? Valuations, we could be at 100 PE on the S&P and the markets could still go higher, which I think we'll talk about in our earnings conversation. But when you look at it, the best month, the history of the S&P is November.
Right.
Right. So do we have a little bit of chop early on, digest some of the gains, reset, move higher? I was talking to an advisor probably about a week or two ago, and we talked about the year end. He's actually been listening to podcasts, moving some of the assets, taking bonuses, maybe dollar cost average back. But did the Santa Claus rally come early this year? Are we going to have chopped in at the end of the year? Only time will tell, but the market does look like it'll recharge. You get the Fed cut rates in October. Next meeting is not till December with November's we'll call it a buy month for him because of Thanksgiving.
How is the market pricing the cuts in and the potential in December?
The rate cut in October was obviously anticipated as well as September. I believe they will cut in December. There's a little bit of market headlines that said, Powell made some comments that said, it's not a guarantee they cut rates. We've still got, as of today, it's the longest government shutdown in history, 35 days and counting. We've got elections, big ones in New York City that everyone's talking about. A couple key governor races in New Jersey and Virginia. So I think maybe after the elections, Democrats will come to the table and pass a clean resolution and open up the government. But with that said, back to your question, the labor market has been weak. We'll get ADP tomorrow, so I do think they cut again in December. I don't think they want to spook the market, so we'll be getting new, fresh data once the government reopens. So I do think they cut.
Okay, let's talk about how the companies are doing. 65% of S&P companies have reported, 85% are beating expectations. So what does that tell us about corporate health in general?
Corporate health is really healthy, right? So when you have 85% of companies beaten going through third quarter earnings here with an average median of 5%, some earnings raises, it's all driven by AI. I saw a stat the other day. 90% of our GDP growth right now is AI driven. So when you look at that and you look at the S&P 500 returns, the 8 biggest tech stocks control 35% of the S&P now. So it is tech heavy, I would say. We just alluded to 6% of the Russell 3000 are 52-week lows. I do think that when you look at kind of those numbers, if we were to have a stalling out in kind of the AI thesis, that leads to the first real big correction, maybe 10, 15%. I don't think it will lead into a bear market until end of 27. But it's still an AI narrative for the most part.
How should we feel about that concentration? I mean, I guess it's hard to predict, obviously, because sometimes it certainly makes sense, but it seems a little.
Yep. So it's good now.
Yeah.
But I would say it's worrisome. So there's a saying in the market: you take the staircase up in a bull market, and you fall down the elevator shaft in bear market. So just think if that AI narrative unravels. The one thing I did see in the last couple of weeks, going through corporate earnings, a lot of these tech stocks are taking on a lot more debt. They print cash left and right, and some of the debt isn't even going on to the balance sheets because it's through private credit. Meta, in their most recent report last week, $30 billion in debt through the corporate bond market, $30 billion in private credit, which doesn't go on the balance sheet. So these companies are borrowing more money. Rates are going lower. Still a favorable rate environment for them. But I actually had a conversation with an advisor last night at dinner, and the one thing that I went back to, kind of that .com bubble, and it happened in the mid 2000s. You have these. Everything's chip related, right? NVIDIA, we talked about NVIDIA.
Right.
NVIDIA just went from 4 trillion to 5 trillion in market cap in 73 days. We talked about on our last podcast how on a forward PE, they're only at 27. So they're not super expensive right now. We talked about Cisco during the .com bubble, going from $16 to $80, and the PE went to almost 200, right? So when you kind of look at companies in that vertical, so to say, they still can go higher. But to my point on that, when into .com in mid 2000s, they're buying chips to get ahead of the supply curve, and when the slowdown happens, they walk away from those orders. So I think that could be one of the theses that causes maybe a bear market in late 27. I don't think it's here right now.
And well, speaking of valuation, so S&P PE 31, forward 24, CAPE is 40. You've got high valuations, but momentum is strong. How do you invest like that?
Well, it's like we talked about on the last time we met, right?
Yeah.
Price dictates everything.
Right.
Until price breaks down, whether that's 50-day moving average, 100-day. The real break is typically the 200. But then when you look at the market breadth, as more and more companies hit 52-week lows, that's where price will dictate the caution. When we talk about what we do here at Quantum, everything's principal protection. We're on the fixed side. You take 20% bonuses now. We have that S&P 8000 white paper. We probably in the last 30 days since the last one have sent that out hundreds of times. We have advisors taking advantage of it. Why not take 20% more on your asset classes right now? The market does correct 30%. You dollar cost average back because we've got high liquidity in a couple of our products. Income riders are hot to trot right now. And the reason, in my belief, is because the advisors that we work with are listening to our VPs. Interest rates are coming down. The long end of the curve controls, everything that we do on the product development side of the nexus. So if interest rates move lower, which they're anticipated, we're back at 4%. I think we're at 3.86, 3.9. That means right now we're seeing participation rate and cap rate cuts on the indices first and foremost. That eventually leads into the bonuses that we're able to give, as well as the income riders. If you look at going back to 2021, 2022, when the Fed started raising rates, the income products today are 40, 50% higher than they could get back then. So why would you wait if you have a 60, 58, 65-year-old that wants to de-risk a portfolio? They just made a ton of money, hopefully in the market, listening to their advisors. Take some of that off the table. De-risk the portfolio. If markets go back to 4,800, dollar cost average back 10, 20%, whatever that may be. But our advisors are listening to the VPs. I think they're maybe listening to us because we just had a hell of a month and there's a lot of bonus and income products in anticipation of those rate cuts.
This all makes sense from our last conversation talking about the idea of getting the AP at the S&P at 8,000. Well, you've got Morgan Stanley looking at the S&P going forward, either, what is it, 7,300 or 4,900. Yep. This would be a great time to do that, what you just talked about, right?
Yeah, and we always talk about the best guesses, right? Wall Street's really good at the 10-year forecast, which is why we used the index standard in our forecast and methodology on a longer term. But when you talk 1 and 2 year resets in our market, Morgan Stanley, they were just, I think it was last week, came out, and their bull case is 7,300. If we hit 7,100, did they go to 74, 75? They'll tweak it a little bit. But their bear case for next year is 48, 4,900. So you have a 3% upside and almost a 30% downside. The risk reward for these retirees, in my opinion, isn't there. So if their bull case is 73, and let's say they adjust it. Let's say we have a Santa Claus rally go in the first quarter, earnings are still strong, AI is still booming. The big 8, we'll call it, is carrying the market again. Why would you have a retiree or pre-retiree stay invested in that market when you can take a 17%, 20% bonus, move some of those assets into principal protection? If the market does pull back to that 48, 4,900,
you're good.
Dollar cost average back in to the Microsofts, Amazons. My guess is if they're a retiree and advisors are managing for income, you can buy Verizon with a 7% dividend, or AT&T or Chevron, Exxon with 3-4% dividends. Just from an advisor point of view and former portfolio manager, it just makes sense to look at the products that we have with bonuses or guaranteed income and take advantage of where markets are today. This
is why he is the Vice President of Advanced Planning and Portfolio Solutions. I want to go back to the rate cuts again. So assume we get another rate cut in December, either due to a reduction in labor or the government slowdown or some other thing. Which parts of the market are going to benefit from that?
That's a really tough question because we just talked about the limited potential upside.
Right.
I do think a couple different parts of the market that could benefit. And when we look at kind of the indices inside, I think healthcare, because it's beaten down pretty good. They borrow a lot of money for their R&D. I think that could be a space. Small caps take advantage. The smaller companies that usually have variable rate loans on the books. It'll benefit the small and mid cap companies to a degree. But I think the housing market as well, right? So the housing market and mortgage rates are obviously tied to the longer term yield curve. The Fed only controls the short end. It's basically your overnight lending. But I think if you had the Fed lowering rates, it means there's maybe a little bit more economic trouble, we'll call it, under the hood. So that should lead to the 10-year and the 30-year coming down as well. So I think the housing market would benefit. But again, the Fed controls the overnight lending, your SOFR, money markets. So if that's the case and money markets are going lower, where's that cash go? It goes back into the market.
Yeah, and I guess, so we've talked about a lot of issues here today. So for the average investor, the advisor, what's the move right now? I mean, just to summarize.
take advantage of what the market's given you, especially the last 6 to 7 months, right? We just talked about historic run, Nasdaq's up 7 straight months. On the last one, we said, don't be a hero. If you have someone that's 55, 60, retiree, pre-retiree, it's been easy money if they've been fully invested into the market. Take advantage of the bonus products while they're still high, right? 17 to 20%. On cash bonuses that goes right into the bottom line. Put 100 grand in, you're at 120,000 day one. That's S&P 8,000 or thereabouts where we're at today. And if you're looking for bridge the gap to full Social Security, you want to cover core expenses in retirement. The market just gave you outstanding returns to where we are at, we'll call it S&P 7,000. Lock in some of that guaranteed income, de-risk the portfolio. And revisit, in 27 if we do have that next big correction or bear market and dollar cost average back in. But it's not going to get much better than it is today when we talk about product features and benefits, because if the Fed lowers rates, that's going to affect our pricing, and they won't be as good on a move forward basis going into 27 as they are today, in my opinion.
He's Andy Moore, Vice President of Advanced Planning and Portfolio Solutions, and he's right here in Scottsdale at the Quantum Group. This is Moore Market Insights. Thanks for watching.